Okay, so the first question which we are solving in today's working capital management class, this question is called Candy Company. It's in the handouts which has been provided to all of you. So let's start reading the question. This question states, this scenario relates to 5 requirements. This scenario relates to 5 requirements. Candy Company purchases a number of different products. Candy Company purchases a number of different products from various manufacturers, which it then sells on credit to a number of large retailers. Candy Company purchases a number of different products from various manufacturers, which it then sells on credit to a number of large retailers. Candy Company is currently reviewing its working capital investment policy, and 2 independent options are under consideration. Candy Company is currently reviewing its working capital investment, and 2 independent options are under consideration. Independent option means there are 2 separate options. Okay. Number 1, a bulk purchase discount from one of its biggest suppliers. A bulk purchase discount from one of its biggest suppliers. And number 2, offering an early settlement discount to its customers. Bulk purchase discount option is one of Candy's biggest selling items is the gimbal. Biggest selling item is the gimbal. Candy pays $30 for a gimbal. Candy pays $30 for a gimbal. This means this is the purchase price. Candy pays $30 for a gimbal. This is the purchase price. And annual sales demand is 18,000 units. Annual sales demand is 18,000 units. At present, Candy's order size is 1,000 gimbals. At present, order size is 1,000 gimbals. That means at the moment it orders 1,000. And each order costs $75 to place, excluding the purchase price. Each order costs $75 to place. Annual holding costs are equivalent to 9% of purchase price of the gimbal. Annual holding cost is 9% of the purchase price. Due to high level of demand for gimbals, Candy always holds a buffer inventory sufficient to cover 2 days demand. Buffer inventory is held consisting of 2 days demand. Candy has been offered a bulk purchase discount of 1.5% of the purchase price if the company increases its order size to 1,500 gimbals. So what was the current order size? 1,000 gimbals. Okay. And it has been offered a bulk discount of 1.5% if order size is increased to 1,500. So obviously we know that bulk purchase discount is offered if we purchase in bulk. So at the moment we were purchasing 1,000 and order size will be increased to 1,500. Then we will get a discount of 1.5%. Although this is 50% more than the size of current order quantity. This is 50% more than the size of current order quantity. Current order quantity was 1000 and now we are asked to purchase 1500. So this is 50% more than the current size. Candy feels it has sufficient storage capacity to accommodate this, but annual holding cost would increase to 10%. Annual holding cost would increase to 10%. Also, the increased size of order will result in higher delivery cost, increasing the cost of placing an order by 25 per order. So current ordering cost was 75 per order. This will increase the cost of placing an order by 25 per order. That means ordering cost will become 100 per order. If accepted, Candy would still maintain a buffer stock to cover 2 days demand. If we accept this, we will still keep buffer stock of 2 days worth of demand. Now this portion belongs to bulk purchase discount. What was the other option? Early settlements. Candy has total credit sales of 45 million per year, and all Candy's customers are equal in terms of sales value. Although Candy current credit terms require payment on 30 days, only 60% of customers pay on time. The remaining 40% pay in 40 days. Okay, so current sales are 45 million per year. Candy's current terms require payment in 30 days, but only 60% customers pay in time and remaining 40% are paying in 40 days. Candy is considering introduction of an early settlement discount of 0.5% for payment within 10 days. Remember, payment within 10 days means we will pay on 10th day. So Candy is considering the introduction of early settlement discount of 0.5% for payment within 10 days. It expects 50% of customers will take advantage of the offer and pay in 10 days. 20% will still pay 2 terms. Will still pay 2 terms means pay in 30 days. Will still pay 2 terms. Pay in 30 days. And there will be 30% who will continue to pay on average of 40 days. Candy finances in short term at a cost of 7% per year. Cost of finance overdraft cost is 7% per year. Note, assume a 360 day per year for all calculations. This will be mentioned in the question that you have to assume 365 days or 360 days. Okay. Now this ends the question. So scenario related to 5 requirements. Let's just quickly go through the question again. Candy purchases number of products from various manufacturers, which is sells on credit. Candy currently reviewing working capital investment, and 2 options are under consideration. One was bulk discount and one was offering early settlement discount. The first portion related to bulk purchase discount. In the summary of bulk purchase discount, Candy's product was the gimbal. It pays $30. Demand was 18,000 units. At present, order size is 1,000. Each order costs 75, holding costs are 9%, and buffer stock is 2 days demand. Candy has been offered a bulk discount of 1.5% if it increases order size to 1,500. This is 50% more, but holding cost would increase to 10%. Ordering cost would increase by 25 per order, and buffer stock will still be 2 days. Early settlement discount, it is mentioned credit sales 45 million. We require customers to pay in 30 days, but 60% pay on time, remaining pay in 40 days. It is considering introducing early settlement discount of 0.5% for payment within 10 days. 50% will take advantage of the offer, pay in 10 days. 20% will pay in still payment terms. Still pay terms means same 30 days, and 30% will continue to pay in 40 days. 7% overdraft rate, 360 days. Now, if we go to the requirements, we know that in section C question, there will be some requirements relating to theory and some relating to calculations. Okay. Requirement A. Calculate the financial effect of accepting the bulk purchase discount. A2. Calculate the financial effect of offering early settlement discount. And number 3, using your result from 1 and 2 above, comment on the financial acceptability of each option. That means the 12 marks of part A relate to calculations. Okay. So let's start this question. Presentation has no marks, so don't waste your time in the examination improving or reducing the presentation. Okay, so Candy Company, and we are doing requirement A first. that is calculate the financial effect of accepting bulk purchase discount. Financial effect of accepting bulk purchase discount. Now this is worth 6 marks. Financial effect of accepting the bulk purchase discount. Okay. Now what should be the good strategy in the exam? That if you are calculating the financial effect of accepting the bulk purchase discount, this particular requirement relates to only which portion? Bulk purchases. Calculate the financial effect of accepting the bulk purchase discount. So this requirement only relates to bulk purchase. So the relevant thing is that we should only focus on the data of bulk purchase discount. Okay. Now let's perform the stuff. Calculate the financial effect of accepting bulk purchase discount. If we read the bulk purchase discount head again, one of Candy's biggest selling items is the gimbal. Candy pays $30 for a gimbal. So purchase price is $30 per gimbal, right? Purchase price is $30. Candy pays $30 for gimbal. Annual sales demand is 18,000 units. So sales demand is 18,000 units. Okay. At present, Candy's order size is 1,000 gimbals. Currently, we order 1,000, and each order costs $75. So ordering cost is $75. Annual holding costs are 9% of the purchase price. So holding costs 9% of the purchase price. So 9% of the purchase price means 0.099% of the purchase price. Purchase price is how much? 30. So this is the holding cost. Okay. And due to high level of demand, Candy holds a buffer stock to cover 2 days demand. Buffer stock is equal to 2 days demand. So we can easily calculate it. 2 days demand. What is the demand? 18,000 for the whole year. How many days? That means if we divide it by 360, not 365. Okay. This will give us the daily demand. Multiply by 2. So the buffer stock is 100. Candy has been offered a bulk purchase discount of 1.5% of the purchase price. Discount is always on what? Purchase price. If the company increases the order size to 1,500, although this is 50% more, but feels it has sufficient capacity, holding cost would increase to 10% of the purchase price, no problem. And increased size of order would result in high delivery cost. Ordering cost would increase by 25 per order, and still buffer stock 2 days. Okay. Now calculate the financial effect of accepting the bulk purchase discount. Okay. Now we have solved this multiple times in the classes. Financial effect of accepting the bulk purchase discount. What is the current order size? 1,000 units. The current order size is 1,000 units. Okay. So remember, the first column we will make is 1,000. Okay. And the discount is being offered if you purchase how much? 1,500. So remember, if in order to check what is the financial effect, saving or loss, we need to compare both of them, right? So we will make 2 columns, one of 1,000, the current order size, and the other of 1,500. Okay. We are currently ordering 1,000. Now, if we currently order 1,000, what cost we will incur? TPC, total purchase cost. TOC, total ordering cost. And THC, total. If we purchase 1,000, we will incur 3 types of costs: purchase cost, ordering cost, and holding cost. Just to remember the stuff, what was the formula of total purchase cost? Purchase price per unit into annual demand. Okay. What was the formula of TOC? C naught multiply by number of orders. And number of orders was, remember, annual demand over EOQ. And what was the formula of total holding cost? CH into average stock. Okay. So we are currently ordering 1000. Let's check what cost we are incurring on 1000 units. Please see on the screen. Please see on the screen what cost we are incurring on 1000 units. Due to Excel, we don't need to use the calculator. Okay. TPC. It's purchase price per unit into annual demand. Now, what is the purchase price if we purchase 1000? 30 multiply by annual demand 18,000. Okay. Total ordering cost. C naught into number of orders. What is C naught if we purchase 1000? 75. What is C naught if we purchase 1000? 75. Okay. Multiply by number of orders. And how do we get number of orders? Annual demand over EOQ. So what is the annual demand? 18,000 over EOQ. How much we are ordering at the moment? 1,000. 1350. Okay. THC. THC is CH into average stock. So what is CH at the moment? 9% of the purchase price. So 9% of the purchase price, 9% of 30, 2.7 into average stock. What was the formula of average stock? Safety of buffer stock plus half EOQ. So safety or buffer stock is 100 plus half EOQ means half 1000, 500. Average stock is safety stock plus buffer, safety stock plus half EOQ. So half EOQ means half 1000, 500 plus buffer stock 100. This is okay. And if we add them all, we will get the total cost at 1000 units. That is 542,970. Okay. This is the cost if we purchase how many units? 1000. Now, what are we being offered? Purchase 1,500 to get a discount. What is the financial effect? In order to check that, financial effect means saving or loss, and you have done these questions multiple times. Okay, to check the financial effect of bulk purchase discount, we need to calculate the cost now on 1500. Let's calculate TPC, THC, TOC on 1500. Look at the screen, please. TPC is purchase price per unit into annual demand. Purchase price per unit into annual demand. So what is the purchase price per unit? Purchase price per unit at 1,500 units is not 30. 1.5% less. So how much? How much? 29. Okay, so purchase price per unit at 1,500 is not 30, 1.5% less. So 29.55 multiply by annual demand is 531,900. Okay. Total ordering cost. It's C naught into number of orders. So what is C naught? Not 75. Remember, when you purchase 1,500, ordering cost increases by 25, becomes 100 into number of orders. Annual demand over EOQ. So what is the annual demand? Over now EOQ? 1,200. Okay. And total holding cost. It's CH into average stock. CH will now be 10% of purchase price. So we can write also here that new holding cost is now 10% of purchase price. So 0.1 of purchase price is 29.55. 29.55. So this is the new holding cost. 2. 955. And average stock is half of EOQ plus safety stock. So safety stock is still 100. Still 100 2 days demand, and half of EOQ is 750. So this will become 850, right? If we add these, $535,611. This is the cost if we purchase 1,500. So what is the financial effect of accepting the bulk purchase discount? If you compare, what is the financial effect we are getting of accepting the bulk purchase discount? Saving or loss? Financial effect is a saving of how much? Take the difference. 7358. Same. So this completes requirement 1 of 6 marks, that what is the financial effect of accepting a bulk purchase discount? It's resulting in saving of 7358. Okay, now we are now moving towards part B of this question, and part B was calculate the financial effect of offering early settlement discount. So the next part is financial effect of offering early settlement discount. Now we all know that in order to solve this particular part, we should only focus our attention on the date of early settlement discount. Now the bulk purchase discount portion is not relevant. Now let's read the financial effect of offering early settlement discount, the date of early settlement discount. Candy has total credit sales of 45 million. So credit sales are 45 million. All customers are equal in terms of value. Current credit terms require payment in 30 days. But 60% customers pay on time, remaining 40% pay in 40 days. Candy is considering introduction of early settlement discount of 0.5% for payment within 10 days. 50% will take advantage, pay in 10 days. 20% will still pay 2 terms. You got the point that still pay 2 terms means still pay in 30 days. And 30% will pay in 40 days. Overdraft rate 7%, 360 days here. Financial effect of offering the early settlement discount. Now, it's very important. You have studied 2 portions of early settlement discount. One is offering early settlement discount, that was in debtor management, and one is accepting early settlement discount in creditor management, and both have different formats, right? One was offering the early settlement discount, debtor management, and one was accepting early settlement discount, creditor management. In accepting early settlement discount, we used to make 2 columns: accept, reject, and then decide. That was creditor management. And in offering early settlement discount, debtor management, there was a format: cost of discount, decrease in finance cost, decrease in admin cost, decrease in bad debts. Okay, so first you have to select, this is offering early settlement discount or accepting early settlement? Offering, part of debtor management. So since it's offering early settlement discount, let's make the format. The format was, first we need to record cost of discount. Okay, and after cost of discount, there were some benefits, and benefits were: number 1, decrease in finance cost; number 2, decrease in admin cost; and number 3, decrease in bad debts. And after recording all of this, we just used to compare what is the cost of discount, because discount results in a loss, a cost, less recovery, but gives the benefit, early payment, decrease in finance cost, decrease in admin cost, decrease in bad debts. Okay. And then we used to get net benefit or net loss. Okay, let's start. Firstly, we need to have cost of discount. And I think in order to do cost of discount, it's better that we do working in a cell. So let's do the working of cost of discount. Please pay attention. In order to check cost of discount, what I have taught you in the classes, we need to compare our existing recovery and new recovery. So existing recovery. Existing recovery. What are the sales at the moment? Please pay attention to the screen. Existing recovery. Okay, so if we talk about cost of discount, I have told you to check firstly existing recovery. So remember existing recovery. What is the sales? 45 million. If we don't offer discount, how much we will recover? Full 100%. Okay, full 100%. Full 100% means 45 million. Okay, and what is the new recovery? If we accept discount, now I want you to please pay attention to this calculation of new recovery. Okay, now what is the new recovery if we discount, if we offer discount? If we offer discount, what is the sales? 45 million, right? We will recover 0.5% less. 0.5% less means we will recover 99.5%. But the problem is, this is not for all customers. Okay. So only 50% will accept this accept the discount and pay in 10 days. 20% will not accept discount, pay in 30 days, and the remaining 30% will also not accept discount, pay in 40 days. So either we can do in 3 pieces or either we can do in 2 pieces. It's simple. 50% will accept discount. So 50% will pay in 10 days, and remaining 20 and 30, all 50% won't accept discount, they will pay full. So we can do the new recovery. Please see the screen how I'm calculating. 45 million. We will recover 0.995. 99.5% or 0.995. Not for all. Only for 50% customers, right? Understanding the calculations? Okay. 45 million. We will recover less money, 99.5%. Only from 50% customers. The remaining 50% customers, that is 0.5, will pay us full 100% or 44.8875. Okay. So this is the new recovery. That is 44.88. 8875. So how you will get the cost of discount? Cost of discount is the difference. Okay, so take the difference. Cost of discount is 45 and 44.8875. 0.1125. This is the cost of discount. Okay, let's see the calculations again. Cost of discount was calculated in the classes by comparing existing recovery with the new recovery. So existing recoveries, credit sales are 45 million. If discount is not offered, everyone will pay full amount. That is 45 million. So recovery will be full 100%, 45 million. But if discount is offered, what is the new recovery? 45 million is the recovery, credit sales. If all people were availing discount, we would have simply multiplied it with 99.5% that everyone is availing discount. But only 50%, 0.5 is availing discount. That means they will pay in 10 days. So they will get 0.5% discount. They will pay 99.5%, but the remaining 45 million, they are paying in full, not taking discount. So remaining 50% will pay in full 100%. So the difference is cost of discount of 0.1125. Okay, I have opened the calculation cell. If you want, you can copy this working of cost of discount and then we will resume it. Okay. Okay, so this was the working of cost of discount portion. Okay, now if we offer discount, we incur a cost. Cost means we incur a loss. That's 0.1125 million. Okay. But we get some benefits as well as taught in the class. The benefits are finance cost decreases, admin cost decreases, bad debt decreases. Now the justification was if people will pay early, there will be reduction in bad debts. If people will pay early, our administration burden will decrease. And if people will pay early means our overdraft cost will fall. That is decrease in finance cost. Now the good thing in this question, please pay attention. Now, the good thing in this question is there is no information about bad debts. So this will be 0, right? There is no information about admin costs. So this will also be 0. The only information is respect to increase in finance cost. So now we will calculate decrease in finance cost portion. Please pay attention. Decrease in finance cost portion. Now, decrease in finance cost was also calculated in the same manner that we firstly calculated our existing finance cost and then we calculated our new finance cost and then we found the increase and decrease. Okay, so please pay attention. Existing finance cost. I'm just performing the working in one cell. Existing finance cost. Okay, now please pay attention. We are doing working of decrease in finance cost. Okay, we are doing working of decrease in finance cost. Now, what was the existing finance cost of the company? Please pay attention to these calculations. What was the existing finance cost of the company? I want you to please focus on the screen. Existing finance cost of the company. Existing finance cost of the company was what are the credit sales? 45 million. Please pay attention. What was the credit sales? 45 million. That means 45 million worth of goods were sold on credit and our 45 million was blocked. Our 45 million was blocked. Okay. This blocked cash was received in how many days? Existing. Not a single answer. Because 60% paid in 30 days and 40% paid in 40 days. That means to calculate existing finance cost, we need to have a breakup. 45 million was blocked. Please pay attention. 60% customers pay in 30 days. So for this 60%, please pay attention. 0.6. We need to raise finance at overdraft rate. What was that? 7%. For how many days? 30 days. 30 over. But the 45 million credit sale was blocked. What did the remaining 40% customers do? 40 days. So for this 40%, 0.4, we need to raise finance at 0.07. For how many days? 40 over. So is this calculation of existing finance cost clear? 45 million was blocked, 60% at 7% in 30 days and remaining 40% at 7% in 40 days. So this is the existing finance cost, 0.2975. 0.2975. Okay. Copy this quickly. Okay, now let's focus on the working of new finance cost. And I think after doing this particular question, it's now very easy. Now, have you understood the clear point regarding the new finance cost? What is happening in the new scenario? 50% customers are paying in 10 days, 20%, 30 days, still terms, and 30%. So I think we can calculate the new finance cost easily. Open the bracket. What are the credit sales? 45 million. That means the block cash is 45. Block cash is 45. Okay. So 50% are paying in 10 days. That means we will calculate 50%, 0.5. How many days? So 7% overdraft for 10 days. 10 over 360. Plus 45 million. What percentage? 20%. This is raised for 7%. For how many days? 30 days. And what is the last portion? 45 million. How much percentage? 30%. 0.3. At 7%. For how many days? 40. 0.2015. Okay. Just pay attention. If we compare this, what will be the decrease in finance cost? To calculate the decrease in finance cost, we will just take the difference of N35 and N37. 0.09625. So decrease in finance cost is 0.09625. Now just pay attention, please, on the screen. Now, if we follow our format, the cost of discount was 0.1125 million, the loss, and the benefits were only, add them all, 0.09625. So what is the net benefit or loss? The cost is 0.1125 and the benefits are 0.09625. So if we take the difference, financial effect is loss of 0.01 million. Okay, now the 10 marks of calculations are complete. Now the 10 marks of calculation are complete. Okay. Now there is a requirement A3. Please pay attention. Requirement A3. What does requirement A3 state? See, please, it's a 2-mark requirement, and 2-mark requirement states using your result from 1 and 2 above, comment on the financial acceptability of each option. Please pay attention. Now, if you see the difference in requirement A1, A2, and A3, what was A1? Calculate the financial effect. Calculate the financial effect. What was requirement A2? Calculate the financial effect. And what is requirement A3? Comment on the financial acceptability. So we just have to state the financial acceptability. Now, in requirement A1, were we getting a benefit or a loss? Benefit. So what will you comment on the financial acceptability? A1 results in savings of how much? What were the savings of proposal 1? 73.25. We should accept that proposal, but proposal 2 was resulting in loss of 0.01625 million. We should reject that proposal. Starting now, requirement B. Requirement B. 4 marks. Discuss the working capital objectives of liquidity and profitability and the conflict between those objectives. We have to discuss the objectives of profitability and liquidity and the conflict between those objectives. This is a theoretical requirement which was covered in lecture number 1 of working capital management. Okay. I informed you in lecture number 1 that there are 2 objectives of working capital management every topic. One was profitability, earning profit, and number 2 was liquidity, keeping cash. There were 2 objectives of working capital management: profitability, earning profit, and liquidity, keeping cash. But remember, I told you there is a conflict between those objectives, that whenever we go for profitability, we lose liquidity, and whenever we go for liquidity, we lose profit. Like, for example, we try to keep cash with us. What do we get? Liquidity. But this cash is not invested. So what we are losing? Profitability. Similarly, let's suppose we keep high levels of inventory. We will sell that and earn profit. We are getting profitability. But keeping inventory means our cash is blocked. We are losing liquidity. So there is a conflict between them. You can explain this concept via these 2 examples, and that's it. 4 easy marks. Okay. Theory is not difficult if you know the art of it. Okay. So how will we write this answer? Read the requirement, discuss the objectives of profitability and liquidity. So first you need to discuss both of them, get 1.5 mark, and explain the conflict between these. Okay. Same class lecture. Okay. So look what answer I am writing, and don't need to copy, just understand it. There are 2 objectives of working capital management: profitability, that means earning profits, and liquidity, that means keeping enough cash. Okay. Now, if I write this, I might have earned 1 mark, because I have discussed the 2 objectives: profitability, which means earning profits, and liquidity, that means keeping cash. However, there is a conflict between both, because if we go for profitability, we might lose liquidity, and if we go for liquidity, we might lose profitability. Now, if you stop here, you would hardly earn 1.5 marks. Okay, because you have done an incomplete thing. You have discussed both objectives of profitability and liquidity, and you have also said that there is a conflict, but the question was discuss the objectives and the conflict. So you have stated there is a conflict, but you have not proven that. Okay, so how to enhance the answer now? There are 2 objectives of working capital management: profitability means earning profits, liquidity means keeping cash. However, there is a conflict. If we go for profitability, we might lose liquidity. If we go for liquidity, we might lose profitability. For example, if we keep cash with the organization, we have liquidity, but this cash is not invested anywhere, so it is losing interest income or profitability. Similarly, if we keep high levels of inventory, we will get profit by selling that inventory, but keeping inventory blocks cash, so we might lose liquidity. If you want to extend the answer further, I have given you this example with respect to receivables as well. If we keep high level of receivables, high level of credit sales, what do we get? Profitability. more receivables, more credit sales, more profit. But obviously keeping high levels of receivables again means cash block. We are losing liquidity. So I think explanation of the point, telling that there is a conflict, 1 mark, and then giving 2 examples. That's enough to score 4 marks. This is a tendency among students that they try to expand their answer. You can add 1 more point of receivables and that's it. No need to prolong your answer too long. Examiner prefers to the point answers. Okay. And the last requirement. This is related to requirement C. The last requirement is related to requirement C. Now in requirement C, we are again asked a point that has been discussed in classes. Explain cash operating cycle. We all know what is cash operating cycle and discuss its relationship with the level of investment in working capital. And we all know what is working capital, current assets minus current liabilities. Okay. So firstly, we need to answer this point, explain the cash operating cycle. So what were you taught? Explain cash operating cycle. What is cash operating cycle? Difference between suppliers being paid and money being received. It basically is how much time there is shortage of cash, incoming flows and outgoing flows. So we will write cash operating cycle is the difference between suppliers being paid and money being received from customers. It basically tells for how long we will be facing shortage of. Now, was this statement taught to you? Yes. So this is explain cash operating cycle, explain the term cash operating cycle. That means by writing this, you gain 1 mark. Explain cash operating cycle, you gain 1 mark. Discuss its relationship with the level of investment in working capital. Now we need to discuss its relationship with the level of investment in working capital. We can write cash operating cycle has a direct relation with level of investment in working capital. Because if company has high level of working capital, like high inventory, high receivables, it will take more time to sell inventory. It will take more time to take out money from receivables, and eventually more time in selling inventory will increase inventory days and hence increase cash operating cycle. If we have high receivables, it will take longer for them to pay, resulting in increase in receivable days, hence increasing cash operating cycle. Okay, now this question asked us to calculate the cost and benefits of each of option 1 and 2. So we have calculated the cost and benefits of option 1. Now we will do cost and benefits of option 2. Please pay attention. Okay, so let's start this working. Cost and benefits are now being calculated of option 2. Now, since this is the requirement of factoring, what we will do is that first make the format of factoring, and here the Excel or spreadsheet saves time, that we copied everything of the format which was written in option 1. Now we are calculating cost and benefits of option. Now the format is first cost if factor is not appointed, and then the cost if factor is appointed. Now, what are the costs if factor is not appointed? First is interest on bank overdraft, that we have to bear interest on bank overdraft, then bad debts, and then admin costs. And what are the costs if factor is appointed? One-off fee, factor fee, interest on factor advances, remaining overdraft, and bad debts. And now we are focusing on option 2. Let's start first costs if factor is not appointed. Now, if factor is not appointed, we have to raise finance from bank. So first cost will be interest on bank overdraft. How much sales? 28,000. Block cash is 28,000. From where will you raise? 7%. For how many days? 70. So this will be same 375. If factor is not appointed, we have to bear bad debts that are 2% of credit sales, 0.02 of credit sales. How much? And if factor is not appointed, it states appointing factor results in saving and admin costs. Option 2 states admin cost saving and receivable period will be same as option 1. So admin cost saving is 30,000. That means if factor is not appointed, you will still bear 30. So what are the costs if factor is not appointed? Sum of N19 and 21. $965. Obviously, if factor is not appointed, the cost remains same. No need to do workings again. Just copy paste it. Okay. Now, please pay attention. Now we will write the cost if factor is appointed. Option 2. Now, if factor is appointed, is there any one-off fee? Is there any one-off fee? 0. One-off fee is 0. Now, if factor is appointed, how much is the factor fees? 1.5%. In option 1, it's 1.5% of sales, 28,000. So factor fees will be 420. Okay. Now please pay attention to interest on factor advances and remaining overdraft. Now in option 2, how much factor is advancing? That means remaining 20% from bank. If factor is advancing 80%, remaining 20% from bank. So please pay attention to these workings on the screen, please. Now if factor is appointed in option 2, how much sales you are doing? That means cash blocked is 28,000. How much factorial advance? 0.8. Okay, 0.8. At what rate? 0.09. For how many days? 30. This is the interest on bank overdraft. Okay. But factor has only advanced 28,000 sales, 80%. So still 28,000 sales, 20% need to be taken from bank. At what rate bank will give? 7%. For how many days? 30. We have appointed factor. So now receivable days will be 30. So either you take money from factor or bank, it will still come in 30. This makes it 32.21. And if you appoint factor in option 2, do you bear any bad debts? If you appoint factor in option 2, do you bear any bad debts? No, it's a non-recourse basis. Bad debts will be 0. So now cost will be 26. Add all 617. So if factor is not appointed, 965. If factor is appointed, 617.9. So what are the costs and benefits of option 2? Is it a benefit or loss? benefit. How much benefit? Take the difference. 347. Now this is the answer as per our format. People many times say that the examiner format is different. No worries. As per our format, we are getting the same answers. Okay, copy this please. Okay, so in this requirement, please pay attention. In this requirement, it was stated that please 1 and 2 calculate the costs and benefits of each of option 1 and 2. So you have calculated the costs and benefits of each of just a 1 mark requirement. Comment on your findings. Now please pay attention. You have calculated the costs and benefits of each of option 1 and 2. Comment on your finding. 1 was giving. See, 104. And what benefit option 2 was giving? 3, 4, 7. What can you comment on your finding? Since option 2 is giving more financial benefit than option 1, option 2 shall be preferred. Yeah, accept. This completes your 8 marks. This completes your 8 marks. Now requirement B is a test case for you because it's a very general requirement and I don't think you can find it anywhere so much points in the study text as well. Okay, so it's better you use your brain and then decide. Discuss reasons other than costs and benefits already calculated why Oscar may benefit from the services offered by the factoring company. Now you will say that discuss reasons why Oscar may benefit from factoring company. So you are clearly seeing why Oscar may benefit from factoring services because it is getting benefit. But the question is stated other than costs and benefits, why Oscar may benefit from factoring. So ignore the benefits and costs. And we must think of 6 reasons why Oscar may benefit from factoring company. Okay, so let's start writing 6 reasons why Oscar may benefit from services offered by the factoring company. Why?
They don't have to chase the debtors.
They will have
They don't have
free time as opposed to chasing customers. Obviously, factor is not appointed. We have to chase every customer on our own. But if factor is appointed, we don't have to chase customers. So this will save time. Time is a factor other than cost and benefits, right? So this is 1 point. Okay. Any other reason why Oscar may benefit? This will provide insurance against bad debts if we opt for non-recourse services. No need to appoint credit control department, maybe something related to finance. Recovery, please pay attention, will be quicker. Now please pay attention. This may be an incomplete or incorrect point because this relates to cost and benefit. That recovery will be quicker, so finance cost will be saved. Recovery will be quicker and this cash can be invested somewhere to earn benefit. Organization may focus on other important goals like growth, company will get an advantage of expertise in credit control.
सर जी current customers से जो है वो risk management वो भी करनी
Will result in domestic as well as foreign receivables risk management. Like if you remember, in risk management we did a question called leg rec company, and there was a part D. How can you manage overseas receivables risk? So we wrote factoring. So factoring can result in overseas risk management as well. Okay, these are the 6 points. Any other point? But cost reduction is a point already discussed in the cost and benefits part A. So we need to mention lesser dependency on banks. You know, sometimes you get dependent on bank. They manipulate, monopolize the terms. So less dependency. So these can be the benefit. However, if you think for 5-10 minutes, you will definitely get some more points as well. But my advice is, as far as these theoretical requirements are concerned, just before going in the exam, go through the past paper answers and remember one thing. The past paper answers are written by examiners, specialists. Never expect in any paper, not in F9, that you will be able to draft the exact same answers. That is not possible and that is not needed. Examiner doesn't expect that. But just reading gives you a good guidance, gives you increased knowledge, and then you can tailor your own answers. Okay.
So overdraft limit can be used in future and say right now.
We can renegotiate with the bank on a much better terms as far as overdraft is concerned. When we have an option, you can write this as well. Okay. Now, as far as requirement C is concerned, for requirement C, I would advise you to read the official answer. Okay. This has been discussed in the notes file. Discuss 3 factors which determine the level of company's investment in working capital. How much company has invested in working capital? In the notes, it was mentioned. This is the last class of working capital management video recorded lectures. Okay. There are 3 factors that determine the investment in working capital, that whether company has high working capital or low. First is called terms of trade, whether company offers high credit period or low credit period. Second is working capital policy, conservative, aggressive, and moderate. And third is nature of industry which company operates in. Like if you are operating in a supermarket, the level of investment in working capital is very high because it's very fast turnover. But in other industries, it might be too low. So I have written in the notes 3 factors: terms of trade, working capital policy, investment conservative and aggressive, conservative and moderate, and third, nature of industry you are operating in. So we have covered 2 past paper questions. As far as this working capital management revision class was concerned, we will discuss a further working capital management question and some MCQs, MTQs as well for revision in the next class. Okay.